There is such a thing as FX futures trading. Futures trading takes place in numerous exchanges around the world, and many of these different exchanges trade futures on all sorts of different things. I mean, from hogs to weather to whatever, but many different exchanges will trade futures on currencies. And futures are like forwards, in the only major difference being that futures are traded on an exchange. Whereas forwards, it's a bank-to-bank type of transaction. It's traded what's called over-the-counter. And the other major difference being that one futures contract, well, the futures contracts tend to be standardized. And so one futures contract will correspond with sort of a pre-specified number of currency that you're buying or selling. And that's called the multiplier. And so because one futures contract represents a certain number of currency, that has an impact for calculating the profit or loss from FX futures trading. And the formula for profit or loss for a futures contract is going to be that multiplier, which we often call interchangeably the notional, multiplied by the difference between what the spot exchange rate ends up at the time of the expiration of this futures contract and the price at which we originally bought the futures contract, the futures price, the futures rate. And then if we buy more than one contract, a more general formula is for the total value of our position is to multiply all that by the number of contracts that we bought. So this is a value or worth for a futures contract if we are buying. And when you're buying a futures contract, ultimately, you're just making a bet. It's you and someone else on the other side of that trade. You're betting them, essentially, that you think that this exchange rate will go higher, and they're betting you that it won't. So whatever your profit is the other person's loss, and vice versa. And that's why the value to selling a futures contract is really just the inverse or opposite of this amount. And to make that happen, the only difference we need to make between buying and selling a futures contract, the only difference we need to make in calculating the value for those two different positions, when we sell a futures contract, we multiply the whole thing by -1. So let's take an example. Let's suppose that we are going to sell a futures contract. And we're going to sell a futures contract on the Mexican peso. The first thing we need to note for that is whatever the multiplier is. The multiplier will be different for each currency pair. Each futures contract for a different currency will have its own multiplier. In this case, one futures contract on the peso represents 500,000 pesos. We're going to sell a futures contract. And so that determines which of these two formulas that we're going to use. And whenever we enter into a futures contract, there's a price that we have to pay, the futures price, whatever that price is at that time. Let's suppose that this price today that we're looking at is 10,773. That's 10 cents per 1 Mexican peso. And what this price really represents is that, like a forward contract, today you enter into this futures contract. What you're doing today is agreeing a rate at which you're going to buy or sell in the future. That rate is this futures price, 10,773. And so whether you make money or not on a futures position really depends on where the spot rate ends up at. So, you enter into the position today and the spot rate may go up, may go down, may go up, may go down. Where it ends up at the end of all that, at the time of expiration, ultimately determines whether you finally make or lose money. And so let's suppose that at the end of this, the spot rate at this point in time here ended up at 12 cents per peso, USD per Mexican peso. So what happened is that the Mexican peso ended up getting stronger relative to this price at which we had kind of locked in at the beginning of this contract. Since we sold that futures contract, we can use this to calculate our profit or loss by plugging in these numbers. First of all, let's say we just had one contract. Or actually, to make things interesting, say we sold 8 contracts, not just one. And the futures price at which we had sort of locked in to sell at is this 10,773, 10 cents. That goes here. And then the spot rate, what it ended up at, the actual currency ended up at, was our 12 cents here. So the Mexican peso strengthened. And then the final number that we need to plug in here is our multiplier, or our notional amount, because one futures contract doesn't just buy you 1 peso, it buys you a certain number. In this case, one futures contract buys us 500,000 pesos. So that goes here. And then we can, from here, simplify a little bit. Let's, for example, take this part here and see that it looks like this is a positive number, right? And that's because the Mexican peso gained. Simplifying this, it's 0.01239 times the 500,000 notional and times the 8 contracts that we purchased, that we sold. And we sold it, that's why we put this -1 at the front. And what this all simplifies to is a negative number, negative $49,560. So this one futures position ended up at a loss for us, loss of $49,000. That's because in this case, we sold a futures contract on the peso. When you sell a futures contract, you're betting that the price is going to fall. You're short, in other words, thinking that the Mexican peso would depreciate. But when you buy a futures contract, you're betting that the price will rise. You're long. thinking that the currency you're betting on will appreciate in value. In this case, the currency did appreciate. The Mexican peso increased relative to the futures price and bought more USD. It strengthened. But we were on the wrong side of that trade. We had sold the futures contract, expecting it to instead depreciate. And so that's why we actually lost money in this scenario. And in fact, we lost quite a bit of money. And there's one other thing I want to caution when it comes to futures contracts, and that's this idea of a margin. This is a unique thing to futures. Margin means the amount of money required to actually to put this position on. So in other words, with a futures contract, we don't actually have to have 500,000 pesos in order to sell a single futures contract on it. In this case, 500,000 times 8 contracts. So we don't need 4.5 million pesos. A exchange may allow you to buy or sell a futures contract based on putting on deposit only a very small amount of the actual notional size. That's the margin. For example, it may only cost me 5,000 pesos to put onto this position. I only have to deposit that much money, or about $530, more or less, using the futures price. So it's very cheap for me to enter into this position. And because the extremely large notional size, you can, with futures contracts, very quickly lose or gain a large amount of money in a very short period of time.